Hello everyone and Happy New Year. In today's video, I'm going to be reviewing my coffee can portfolio performance for 2024 and going back to inception, which was the middle of 2020. As I've looked more and more into the coffee can portfolio, I've come to realize that this actually might be a very good strategy, just buying and doing nothing for at least 10 years or more. So this is a real-time live experiment into how this strategy works for me in practice. So we'll check in on those portfolios in this video. But first, I had a few member announcements for those of you who are subscribed to the Coffee Can Investing Club. On January 2nd, 2024, I'll be releasing my coffee can scorecards, which are these on the right. Those are all going to be released for the entire S&P 500, so you'll have a packet of 500 of these charts, and then also for the dividend aristocrats. So these are the 66 companies that have raised their dividend for at least 25 or more years. And then also for the first time ever, I'm going to be hosting a live stream. So January 6th from 2 to 3 Eastern time, I'm going to send out a Google Meet link on Patreon, and for those of you that support on YouTube, I'll send you the link as well. So if you want to hop on that, we'll have a conversation, ask questions, just talk, whatever you guys want to do. Should hopefully be a fun time. So if you're a Coffee Can Investing Club member or a YouTube supporter, be sure to check that out January 6th and then look for the Coffee Can scorecards January 2nd. The first coffee can portfolio that I started was an accident. In 2020, in honor of the NFL draft, I did an NFL draft stock style where I bought 32 companies and I ranked them according to shareholder yield. And I used the Vanguard Dividend Appreciation ETF as the starting spot. So I looked at all these stocks in that portfolio, ranked them highest to lowest on shareholder yield, and that was the 32 stocks that I bought. There are 32 NFL teams, so that's why 32 stocks. And I'd meant to do that every single year, just recalibrate the portfolio. But I forgot to do that, so I just ended up leaving it alone, and it's performed quite well. We'll look at the performance since inception here in just a second, but this is how it performed in 2024. Not nearly as well as it's done in previous years, up 14.3%. And that compares with 17% for VIG, which is probably the best benchmark since that is what I selected the portfolio out of. You can also see how it's done relative to the S&P 500 Value ETF, up 15%, and the S&P 500 Equal Weight, up 12.2%. And then, of course, the market cap weighted S&P, up 24.9%. Since inception, which I'm using May 1st, 2020, since I am using Portfolio Visualizer for the benchmark data, the dividend stock draft, which was 32 stocks, grew $1,000 to $2,090. That's the actual portfolio value, which I have over at M1 Finance. That is a total return, including dividends reinvested, of 109%. $1,000 invested in VIG would have grown to $1,884, which is just an 88% return. So definitely pretty solid returns relative to the benchmark. That suggests positive skill, or in this case, quantitative skill, I guess, in selecting stocks. So roughly 21% outperformance over the last 4.5 years. The value ETF is up 92%, equal weight S&P up 96%, and then outperforming everything is the market cap weighted S&P, up 117%. So even though this portfolio is trailing the market cap weighted S&P, I'm still quite content with that. This is an equal weighted portfolio, so probably the best benchmark would be VIG. But the second best would probably be the equal weight S&P. In both cases, it is outperforming those. So I think this, considering the risk and considering the selection, is performing better than I would expect. Here are the top 5 and bottom 5 performers so far since inception. The number 1 performing stock is McKesson, up 325%. And one thing I want to point out about this portfolio, and really all the coffee can portfolios, is how the weightings change over time. So since you're not rebalancing, not selling, not adding money to the portfolio, naturally the winning positions make up a larger and larger position in the portfolio. So McKesson is now at a 5.8% weight when it started at just 3%. GWW or WW Grainger is a 5.6% position. It's up 325% as well. Centos, one of my favorites, up 281. W.R. Berkley up 187 and Republic up 178. All of those are at a higher weighting than when they started. And at the bottom end of the portfolio, the worst performers, you can see that all of them over time have had a smaller and smaller part of the portfolio. Jack Henry up 18, Comcast up only 17, J&J up 5, and then we have two that are actually down, Nike at -8 and Brown-Forman at -36. But if you add up the total weight of the bottom 5 performers, it would be less than the combined weight of the top 2 performers. So if this continues for another 5-10 years, these are going to become huge positions, and these are going to become virtually non-existent relative to the rest of the portfolio. So the losers kind of sell themselves over time, and the winners become increasingly more important. And that's one of the reasons why I think the coffee can portfolio tends to work so well. The next coffee can portfolio was started just a couple weeks after the dividend stock draft, and in this portfolio, what I was trying to do was prove that shareholder yield, which is dividends plus buybacks, is actually a better metric for valuation than dividend yield alone. So my intention was to start 5 different portfolios, each based on 5 different valuation metrics, put $1,000 in those, and then see how those do over time, with rebalancing, buying new stocks, selling stocks that no longer fit the valuation criteria. However, I didn't end up rebalancing them at all. I ended up just leaving them alone, and they've been sitting virtually untouched for 4.5 years. I did do some tax loss harvesting a couple years ago and sold a couple of the losers, but other than that, this portfolio has been untouched. This is the year-to-date portfolio performance from January to December of this year. The shareholder yield portfolio again produced the best return, 27.1% for the year. EBIT to EV was up 21.4. The forward earnings yield, or PE upside down, returned 16.2. Dividend yield performed 15.4, and the Buffett yield again coming in last at 14.1%. And then we compare that to the value ETF, which is probably the best ETF as a benchmark, since these are all value strategies. Comparing it to the value ETF, up just 15%. RSP, again, a very disappointing 12.2. I'm still shocked how much worse the equal weight did relative to the market cap. Market cap weighted S&P up more than double the equal weight S&P, which will not last forever. These have historically gone roughly in line with each other. So I would expect this to mean revert at some point, but 24.9 for the S&P market cap weighted. So the only one of these strategies that outperformed the S&P was shareholder yield. However, like I mentioned with the first coffee can portfolio, relative to the value ETF, which is probably the best benchmark, and the equal weight ETF, since these were equal weighted portfolios to start with, both of these have performed worse. So I am overall very happy with this performance of these portfolios, but shareholder yield in particular. And if we look back to inception, May 2020, the shareholder yield portfolio has grown the $1,000 investment to $2,470. That is a 140% or 47% total return. EBIT to EV yield is up 110%. The forward earnings yield up 104, dividend yield up 99, and then the Buffett yield trailing at 97%. However, all 5 of these portfolios are outperforming the value ETF up 92% and the equal weight up 96%. Only one of them is outperforming the S&P 500 index up 117, that's shareholder yield. However, again, these are all equal weighted portfolios and they're all based on valuation metrics. So I would consider all of these to be outperforming their most reasonable benchmarks. Now looking at the top 5 and the bottom 5 performers from these portfolios, the number 1 performer by far is Quanta Services, up 830%. And like I mentioned, this is kind of how the coffee cans operate. 11.1% is now the weighting of Quanta Services in the shareholder yield portfolio. Second best performer was AMP, up 435, Discover Financial up 388, McKesson up 389, and then United Airlines up 283. Interestingly enough, on the bottom, the worst performers, we have an airline, 26% only up for Southwest Airlines, DXC Technology up just 20%, Tyson Foods up 16%, and then we have two that are down. Xerox Holdings down 32%, and Walgreens has been an absolute dumpster fire, down 72.3%. And again, just to point out the weightings, Walgreens started at a 3%, now it is a 0.5% of the portfolio. And there's one other portfolio that I have never publicly disclosed on YouTube, but I have another coffee can portfolio that I started in 2021 in my Roth IRA. This is another bit of an accident. I did not intend this to be a coffee can, especially not in a Roth. Typically a Roth, you're not afraid to buy and sell since there's no tax consequences, but I just haven't made any moves. I bought some of these stocks back in July of 2021. And I just haven't touched them. So it's a bit of a coffee can, and it goes to show that even if you are in a non-taxable account, the coffee can portfolio can make sense. It just prevents you from making mistakes, prevents you from selling things, from trimming back on winners. Just overall, a very easy to follow strategy that seems to perform quite well, and mathematically, I think it makes a lot of sense. You're getting companies that the winners become more and more important, losers become less and less important. Study any of the great investors and they all say the same things. Water your flowers, pull your weeds, let your winners win, let your losers lose, or just sell them entirely. This is the only one of these portfolios that I did not decide on purely quantitatively. So I did actually select these 22 stocks in my Roth IRA, and I bought those shares based on what I thought were good investments at the time. This is not a quantitative portfolio. So anyways, January 24 through December 24, the stocks in the Roth IRA total return were up 23.1, compared with RSP up 12.8. Again, I use this because this is or was roughly an equal weighted portfolio at the time. So I think this is probably the best metric to use. And then we have the market cap weighted S&P up 24.9. Taking a look at the top 5 performers from this portfolio, we have number 1, Taiwan Semiconductors up 95% in the year, which is wild. Meta up 67.7, Costco up 51.4. Love Costco. Progressive, great insurance company up 40.5%, and then we have Google or Alphabet up 37.2. But just to make sure you don't think I'm a genius stock picker necessarily, these are the bottom 5 performers. IDEX Labs down 25.6, Adobe down 25.3, Pool Corp down 13.8, Monster down 8.8, and VeriSign basically flat on the year. And then since inception performance from August 2021 through December of 2024, I invested $61,793 in this portfolio. It is now worth $92,751, which is a total return of 50% over that time frame. The same $61,793 investment in the equal-weighted S&P would have grown to $74,743, which is just a 21% return. Again, it's wild how much better the market cap weight has done. That would have grown the same investment to $86,924, or a 41% gain. So overall, I'm very happy with this portfolio, outperforming the S&P by about 9% over the course of, in this case, not quite 3.5 years. And in a period where the S&P has performed so well, I think this is a very good result. I'm really happy with how this account has done. So there you have it, the performance for the coffee can portfolio. If you have a coffee can portfolio or you want to start one yourself, I'd love for you to join The Coffee Can Investing Club, it's just $8 a month if you pay annually, or $10 a month if you just want to try it out monthly. Shan says, "This is so much value added for the price. Thank you." And probably a little biased, but I do agree. This is a ton of value add. I want this to be an absolute obvious subscription that you absolutely obviously get at least $10 a month out of. I think you probably get $100 a month of value out of this. 500 stocks, 150,000 different data points, and data going back to 2001 for a lot of stocks. So here we have Apple on the left. You get 500 different scorecards of all 500 companies in the S&P 500 and the dividend index, all that. They're all ranked with an overall score. Just an overall great way to screen for different stocks and just find stock ideas. I just recently added a high PE and a low PE kind of channel, so you can see a little bit where the company is trading at relative to historical multiples. We've got historical dividends here. We've got historical free cash flow, earnings, all kinds of stuff. I rank them green if they're good, red if they're bad, black if they're kind of neutral. So just kind of get at a glance, how eligible would this company be for a coffee can portfolio? In addition to these, you also get 2 e-courses, How to Value Stocks, which has got great reviews, and then also for beginners and intermediates, the Financial Freedom Formula. Both of these courses I sell for roughly $200 each, so it's $400 worth of courses. There's 8 hours of content, nearly 100 video lessons in these 2 courses. They also come with PDFs and Excel templates, so even just for the courses, I think sign up. You can cancel after the first month if you want, but you get access to these courses. I really think they're going to help you out a lot. Thanks to everyone who is currently a member. Again, don't forget the new coffee can sheets coming out January 2nd and the live stream January 6th. Thank you all so much for supporting my channel. Happy New Year, and I will see you in the next video.